Okay, think we're live. So hi everyone, my name is Michael from Deep Value Returns, and on Friday we talk about how to invest. And today I've got a few topics. Some questions have come in, which is great. That's really nice. I'm going to try and talk through those topics. The overarching theme of today is about sector leaders and my thoughts on investing in sector leaders. So I hope that it's enjoyable. As we kind of come in and people kind of get involved and the viewers start showing up, hopefully over the next 25-30 minutes. Hey Taylor, good morning. I'm really happy that you showed up. Thank you. Hopefully over the next 25-30 minutes, you will either ask me something about investing, if you're new to investing, or if you've been investing for a while, something that you kind of wanted to see what I feel about it, my experience, or something that you've read in one of my articles. You've kind of felt, okay, Michael, I like your analysis of this. Could you talk a bit more about this? Just that kind of theme. So essentially, yeah. So one of the things that I've seen a lot of people talk about in the last several months really is this idea of exclusively buying into market leaders. Everyone wants to buy into market leaders. And the problem that I see within that is two things. First, if you're buying into a portfolio of, let's say, 30 stocks and they're all into market leaders, you're going to see the same thing because everyone is investing in those market leaders, and you end up in a position where there's a lot of correlation. And that works well when the market is going up, but when things hit the fan, it kind of gets detached from the underlying fundamentals. So sometimes you have a certain number of companies that are doing something quite well, and then you see that because of other themes unrelated, the whole sector kind of gets punished because investors are kind of become disenchanted with a certain theme of, being the market leader. So that's why I always talk about I have the hybrid portfolio. The hybrid portfolio is where you split the portfolio into high growth names and low growth names. By that, I mean that you have, you can call it traditional value stocks. So these are kind of stocks that not growing a lot, let's say approximately 5% on a top line, 8%. These are like low growth names, but they make a lot of free cash flow. And also they have very strong balance sheets. So these are things that people don't really want to get involved with. And right now in 2021, the market doesn't want anything to do with this. So right now you can buy some really cheap low growth names, even within, let's say, consumer brands, even within tech names. I'm telling you, everyone says that there's a bubble in tech, but I'm saying that seriously, if you're willing to do a tiny bit of work, even within tech names, hey Wall Street, thank you for joining us. Even within tech names, there is a lot of discrepancy and just there's a bit of kind of a divergence. So when I say about people buying into the leaders, I'm talking like, for example, those companies that the CEO is like the brand of the company. The companies that I'm talking about. I don't even need to mention them by name. And you see that everybody's playing that game and they're saying, I'm gonna buy irrespective of the valuation because I know that is the one leading company, and even if I'm paying too high a price right now, over time the intrinsic value of the company will catch up. And that line of thinking works really, really well while the market is going up. Everybody is a buy and hold investor while the share price is going up. Nobody is going to ask difficult questions from their investment. Nobody's going to get involved and say, they missed it. Like, while the share price is going up, it's all good. The problem though is when things, sometimes, hit the fan slightly and then people start asking difficult questions. So what was initially in your thesis, I'm going to hold this for, let's say, over the next 5 years because it's a great company, great CEO, great management team, great this, great that, great narrative. What you see is it becomes quite overwhelming because you see that the stocks are falling 10-15% a day for a week, and then you kind of start reassessing the situation. You're kind of like, yeah, that kind of maybe didn't work out too well, and you end up selling into a panic. And that's why I always have this kind of hybrid portfolio, because the idea of the hybrid portfolio is that it will add some kind of edge, it will add some kind of ability to withstand the turbulence when high growth names fall out of fashion. To be absolutely clear, it's not my expectation that I own, for example, let's say GoPro. Okay, so GoPro is what I'll class as a traditional value stock. That being said, it is growing at more than 20%, so it's not really kind of in the 5% range that I talked about earlier, but it's a company that's growing reasonably quickly at, let's say, this year definitely growing at 35%. The question marks can be next year whether it grows at 20 or not, but for all intents and purposes, in the 15 to 20% bracket. Makes a lot of free cash flow, but investors really don't want anything to do with it. I think it's priced at approximately 11 times free cash flow this year. This is not like some future next year's free cash flow. So something that's really, really cheap. But the market doesn't want anything to do that. Right now, in September, people are really going into high growth names, and you can see that what's happening is that the stocks that were overvalued coming out of July, the stocks that were overvalued, the kind of high market cap stocks. So for example, companies where the market cap was higher than 50 billion, they've kind of kept or even increased their level of being more overvalued, whereas companies, as you come down on the market cap, investors have just been kind of throwing down those smaller market cap companies, even if they're growing at a reasonable rate, even if the fundamentals are strong. Investors are kind of fleeing towards those names, and as I said already, that kind of works really well while nobody's asking difficult questions, because at the moment, everyone's kind of hunky-dory, shares are going kind of roughly up, that's fine. But if you just rewind the clock just slightly into earlier this year, into May, when things were really kind of, since February into May, things were really kind of slowing down and the share prices were selling off, there was a lot of panic around. And you can look at many of these leaders. For example, you can look at, let's say, a firm, you can look at a trade desk, you can look at many of these different leaders in their space, DocuSigns, it doesn't really matter. You can look at so many different leaders, and you can see that the price to sales multiple really kind of compressed, and people kind of like, that my opinion, my enthusiasm, my confidence, my ability to forecast out how the company is going to do is all of a sudden kind of people a bit nervous and unsure. So it is important to try to position a portion of your portfolio. I do 50%, but you can do less you can do a bit more. A portion of your portfolio towards this high growth opportunity, but you have to be humble enough to not put too much of your portfolio into that, because that works really, really well until it doesn't. Okay, so I got a few more questions people wrote into me, but if you wanted to ask some questions to me right now, please feel free to get involved and ask questions to me. So someone just wrote to me, should I leave cash on the side? So I'm not a fan of doing that. And the reason why I don't like to put cash on the side is because I'm an investor for, let's say, 20 years, I call it a 20-year game. So I'm trying to compound my savings to grow them over the next 20 years. So I don't see the point of trying to keep cash on the side. But the counter argument to that is, okay, when things hit the fan, you want to go in and buy in the dips. You want to buy in those cheap investments. Let me tell you something. That when things hit the fan and you've held on to 20% of your portfolio in cash, you are not going to be buying it at the bottom of the drop. Because when things go sour, like they did in COVID, like March of 2020, man, it's just panic. There is no kind of, and you're not going to be able to time the bottom. You're kind of either going to go in too quick, and then things are going to get really, really bad, or you're going to miss the bottom anyway. So in the interim period, you've missed the growth of your capital because you've been holding on to cash, and you're going to miss the bottom as well. It's much better as an investor to think of yourself as a business owner. It's much better to think of yourself, okay, I own this business, I want to own this business for the next year and a half, 2 years. You want to own a business for 3 years. You don't need to kind of try to time how things are going to work out. It's much better for you to buy into a business that you want to own, and then when they miss quarterly earnings, you have the conviction to stay with it. And one more thing that I just wanted to say briefly. One of the things, the best advice that I can give to anyone that is investing is write down 3 bullet points why you buy the stock. I said this last week and I'll say it again. Write 3 bullet points. One of the bullet points has to be valuation. So Because when they miss the quarterly earnings and the stock is down 20%, and that sucks, and you kind of, should I just dump this, go back to that piece of paper or on the cloud or whatever and see the reasons why you bought it. Try and get the conviction. The way I try and make it really simple so that you can do something that's actionable, something that's realistic. If I say to you, write me a 4-page thesis on why you bought XYZ, the majority of people wouldn't do that for the next, let's say, 10 stocks in their portfolio. So if you write 3 bullet points, anyone can do that, and it gives you the conviction to hold on to your investment while things are kind of a bit wobbly in the market. Someone asked me about stop losses. If you wanted to kind of ask me a question right now, please feel free to get in. There's a few people on the call. If you want to get involved and ask me a question, that's fine. Someone asked me about stop losses. So should I hold stop losses, and how big a stop loss should I hold? So the Peter Lynch quote reply to that is, show me a man with a 20% stop loss and I'll show you a man with a 20% loss. So in investing, particularly nowadays, I see that the market is so volatile and you can get so quickly cut out even at a 50% stop loss. And I'll give you an example of a company that I do own, I've been owning for a while, Digital Turbine. The ticker is APPS. And this stock has been like looking 21, man. It's been all over the place. And now it's kind of trending higher and it feels like you can breathe again. But if you had a 20 or 25% stop loss, you'd have been out of that business. And what are you going to do? You get stopped out of that business, you kind of get your cash, and then where are you going to go? You're going to go and redeploy it somewhere else, and you don't know that business as well. And there's just so many different kind of insights that you kind of build by being a shareholder, by being the owner of the business, that you can understand, okay, actually, fundamentally, the business is doing quite well. I find I pay less attention to the market, everybody wants to be a long-term holder, and that works really nicely in theory. But in practice, man, because I look at my portfolio and I say, like, wouldn't it just be great if I could just switch off from all this noise and just kind of hold this business for 3 years? But 3 years of waking up every morning and looking at that stock going sour is really, really difficult. Made even more difficult, like if you're like me, like where you're benchmarking yourself against the S&P and you kind of look at everyone else in the S&P is killing the market, and you have that one stock that's just burning up your portfolio, and it becomes so difficult. And the counter argument to that is that I've seen in the past where if you get dissociated from the portfolio for a length of time, it's really difficult to catch up afterwards. So the S&P kind of rallies ahead, and it's very difficult to kind of make up for lost time. You don't have to benchmark yourself against the S&P. I'm just saying what I do. In fact, I will say to anyone that wants to invest, what you should work towards is compounding at 15%. That's it. You don't need to go towards like from zero to hero. You just need to do this and stay in the game, and you need to do it in a way that your strategy allows you to do the 20-year horizon game and stay invested. So you don't want to go for long shots. You don't want to kind of try to play catch up. Just kind of compound at approximately 15%. I think that's like, you see the maths works out really well. I've mentioned this before. If you have if you compound at 16% and you put 5k in 20 years without any further action, that's 94,000. And the example that I've given in the past is if you compound at 13% but you add to the 5k just $500 at the start of each month, so you compound at a low rate 13%, and each month you add $500, which I'm willing to bet anyone watching this video has $500 that you can live on rice and tuna for a few days of the week to kind of get the $500. If you do that, the 13% compounds to 514k after 20 years. So you start with 5k, compounded at 13, you add $500, which is not a lot. And investing is really just about staying in the process, staying in the game. You want to make it as automated as possible. Someone asked me, are you holding? So when I come to invest in a business, the question is about Digital Turbine. When I come to invest in a business, the way that I see it is two things. I have a lot of rules that I put out for myself because I want to make it as mechanical as possible. If I've made an investment and I made a mistake, I hold it for a year. I'm the business owner, I take that responsibility for my mistake, I hold it for a year, come hell or high water. After a year, if I'm wrong, all bets are off. After that period, let's say for example that I've made investment, it's working out reasonably well, what I'm looking for is a change on opinion. You can call this re-rating. You can, when the multiple expands. I want people to look at, for example, Digital Turbine is an ad tech company. Everyone is concerned about cookies and whether cookies are gonna kill the rest of the market, and you get the multiple is very compressed. So when I look for Digital Turbine, I'm looking for a re-rating. I want people to come and figure out that actually Digital Turbine is going to be okay. So that's going to happen quite quickly over the next, let's say, 18 months or so. If I'm right, that investment is going to re-rate higher, and then I've got the maximum return over a short period of time. Once that re-rating comes, that's really what drives the investment over a period of, let's say, 2 years is a change of perception. Over a period of 10 years, you can pretty much align it with the revenue growth rate. If the revenue growth rate is 5%, you're going to get compounded at 5%, and if the revenue growth rate is approximately 10%, your return is going to compound at 10%. So, but in a period of, let's say, 2 to 3 years, it's really the perception, either perception going down or perception going up. That's really what changes your ability to compound your returns. So the way that I look for my investments is I'm trying to buy things that are kind of slightly misunderstood. I'll give you another example, a company that everybody knows, because might not everyone know about Digital Turbine. So Twitter is an investment that I own and I like, and everyone is thinking, okay, Twitter, old technology, number of users on the platform is not really growing, and something like Snapchat, the number of users is growing a lot faster. Yes, that is the idea that everybody knows about, but what you are trying to do is see, actually, they are still saying that they're going to double their revenue by 2023 to approximately 7.5 billion, by increasing the amount of engagement. So that means that you as a user spend more time on the Twitter platform. So it's not really increasing the number of users, but it's increasing the ability of you spending on the platform, and advertisers targeting you better through direct marketing. Direct targeting is so you get the same number of users, but your average revenue per user, your ARPU, increases, and this drives revenue higher, and ultimately this will drive the multiple that people are paying for Twitter right now to increase. And if that happens, that's going to happen quite quickly. So if I'm telling you that by 2023 they're expecting 7.5 billion, the market normally looks forward about 6 months to a year. So towards the back end of 2022, which is approximately a year's time, people will start thinking towards how 2023 is going to look at, and they start pricing that in. And at that point, you're just holding out from now until then, which is approximately 12 months. So you can make, I own this investment. This is not investment advice. I'm just just giving you an example to think about. But you could make, let's say, 75% return over the next 12 months on something like Twitter. So you get that re-rating. It's not that the company's underlying fundamentals or its intrinsic value is going to grow by 75%. It's just that people's changing perception. So that's what I like to kind of buy. I like to buy these things because I'm a value investor. So for me, valuation is very important. That's what I'm working off. I'm working off the change in valuation. So people say, oh, Michael, you're prolific and you write a lot about different companies and you follow so many different sectors. That's because I'm just consistently trying to figure out how much different businesses go from, always trying to optimize for what a business is worth and trying to understand the valuation. That's why I'm looking at so many different companies. I'm just trying to get in that niche, and I'm just kind of trying to cut out a sector of the market and really being able to, in my sleep, figure out, okay, this is what that business goes for. This business is undervalued, but it's fairly undervalued. There's a reason why it's fairly undervalued. And that business is undervalued, but actually it's wrong. The market is wrong on that one, and that's where you want to be. So I don't want to own, let's say, 30 companies and kind of, I want to know the businesses that I own really well, because what happens is that if you only own approximately 15 companies, not only do you know those businesses better, but your ability to have the conviction in those 15 businesses, because they're your babies, you own those companies, you feel like you have really strong attachment to those businesses. And if you know them, you have the conviction to stay invested the course. One more thing that I wanted to highlight. So one of the things that makes a big difference to amateurs versus professional investors is to have that conviction that I just gave you right now of being an investor, being convicted, being determined to see the business through. But when new facts come in, to be able to say, I'm out. That ability to kind of to say, okay, I thought this, I was convicted, I was seriously thought this is going to work out. But when facts come in and you being able to understand and appreciate those facts really quickly and say, okay, this is my thesis. I wrote these 3 bullet points. This is what I was thinking about as an investor, and actually the facts are wrong. The facts are right and I was wrong, and then I'm out. That ability. We still got a few more minutes. I mean, I've got a few more questions that I wanted to kind of talk people through, but if you want to ask me any question, maybe something that you've seen in the market in the last week or so, something that's kind of interesting to you, please do write a question, get involved. Yeah, that's how you kind of learn. You know, it's really, I always have this idea that when it comes to investing, you get out what you put in. If you come in with an open mind and you're willing to ask questions, willing to get engaged, willing to say, okay, this is what I think, how do you see this? You're gonna come out a much better investor. It's really about being able to have an open mind and really be critical and just being able to learn new ideas. And this is something that I always see from, for example, from Buffett, is his ability to continue to adapt. You know, Charlie Munger calls him the learning machine or something like that. So it's this ability to continuously adapt over time is why Buffett is one of the best investors on the planet, because what he was doing in the 60s is not what he's doing in the 70s. It's not what he's doing in the 80s. So his ability to kind of continue to move over time is really what I think, you know, beyond doubt, he's one of the best investors the world has ever seen, because he's actually playing a really difficult game, because he's saying pretty much, even if I know the business is not going to do really, really well, I want people to believe in the brand of Berkshire Hathaway, that if they sell the business to Berkshire Hathaway, even if your business is underperforming, I'm not going to get rid of this business. So for example, Coca-Cola, okay? So that is a brand that he's trying to build, and it's very difficult to compound at 20% when you know there are things that shouldn't be in your portfolio. I'll give you a great example. So when Coca-Cola was 1999, it was priced at 60 times earnings, okay? And if Buffett had sold that investment right there, that came up to approximately, I think, something like 5% of the market cap of Berkshire Hathaway, and he could have easily redeployed that capital, but he was sticking to his guns. That's the brand. You have a business, and we will stick. You can sell this to the business. We'll keep hold of your business, and that's why he's able to negotiate these really cheap bargains. Anyway, I digress. I just wanted to talk about the importance of adapting, and that's what I really kind of think about when I come to investing. Is everything that I'm learning and I'm talking about right now as an investor, how much has changed over time. And that's because I've been willing to kind of get involved, ask questions from other people. I write a lot on Seeking Alpha, but I also go through those comments and I kind of read what people have said, because I know that I don't know everything, and I'm trying to kind of learn. And everything that I come to investing today, nowadays, is something that in the past 6 months, I would have said, okay, I wouldn't have thought that way. And if I go back 6 months before that, I thought even differently. I'll give you another example. So back in January 2020, I had this idea that if you are a value investor, if you're buying stuff really, really, really cheap that makes a lot of free cash flow, that has a strong balance sheet, if there was ever to be a market sell-off, that the cheapest undervalued stocks would sell off less, and that the very expensive stocks would be just like crumble. One example that I particularly was focused on was Salesforce. This was a business that I was saying, okay, right, this business is really, really expensive. It's a serial acquirer. That game is going to come up, and everyone is pricing Salesforce at a high multiple, and that's my thesis. So when COVID happened, my stocks, Salesforce, didn't matter. Everything just collapsed. It didn't matter what you were investing in. Just everything sold off. But starting after March 23rd, starting that bottom, coming out into April, my stocks didn't come back up. And what came really soaring higher was things like Salesforce. So I'm looking some hindsight analysis, but I'm telling you, okay, I was so wrong. And this ability to adapt over time. So some people clone famous investors, but those investors, no, it doesn't matter about having more capital, because in fact having more capital makes him so much more difficult. So Alibaba is a very controversial name. The reason why Charlie Munger invests in Alibaba is because of Li Lu, most likely. I know that Charlie Munger is quite, is a very independent thinker, but Alibaba is a controversial name. I mean, there are people on both sides of the argument, but what I would generally say is having more capital actually becomes really difficult, because with the exception of, let's say, Charlie Munger, because he's someone that kind of operates with his own capital and he doesn't have a board to kind of pass ideas through, he just kind of does what he wants. But normally, if you're an institution, I'll give you an example. Let's say in an institution and you own Apple. Okay, that's one of your portfolio manager, you own Apple, yeah, everyone's happy because Apple's done really well. Now you think to yourself, Apple's not doing that amazingly relative to what I thought, and it's really, really expensive to stock. For example, just for sake of discussion, are you going to take the career and risk and say, actually, I've made a mistake on Apple, we should sell out of Apples, we should buy something else like, Digital Turbine? No, people will just stick to their guns, and actually becomes really, really difficult to, when you have more capital, because there's more layers that you have to go through. There's so many different board meetings and stuff to convince people to to come out of one position to go into another position. As a DIY investor, you're actually going to have a huge advantage if you're willing to do a little bit of work. You don't need to do a lot of work, you just need to do a little bit of work. One idea a month, man, if you come up with one idea a month or one idea every 2 or 3 months, that's 4 ideas in a year, that's going to be really more than enough. And your ability to have less capital is actually nobody wants to have less capital, everyone wants to have more capital, but it's being able to be so nimble and to be able to take opportunities when things kind of come around and you see something that you've been following for a while and you see something that changes. Sometimes you follow a certain company for a while and you see, for example, I'll give you an example, a firm, because it's just on top of my mind. So you follow a firm and you see that a firm has this deal that comes through and Amazon kind of picks them out. And you're like, okay, that's interesting. I wonder how that's going to play out. And you see the stock goes up and you don't get involved, blah, blah. And then you see the earning results come out and they go through and the market has time to digest that. And you see to yourself, okay, I thought that the company was doing well. I thought the company was expensive, but I can see that there's going to be more upside to this business because they've got this huge brand on a non-exclusive basis. And you can see that I thought it was expensive, but perhaps the valuation is not so important as to understand that it still has a huge runway ahead. So as a single investor, you can put these 2 points together in 2 weeks and you can kind of rock and roll with the idea. If you're a big institution, it's kind of like, man, forget about it. Even if there's like a free team shop and you kind of have to bat the ideas off each other and you have to kind of pound your fist and you have to go with, let's say, a firm, and then you end up that you're wrong. Facts come out and you're wrong. You're not able to kind of X out of that position. You're going to have to stick to that position because you pounded your fist so hard. So as actually a single investor, you can do so much better than just being like a bigger investor. Just before we wrap up, is there any more questions that people want to ask? I mean, I really would love to hear your questions, and I'm glad that you were able to kind of join me this Friday. If there are any more questions, please do write me a question. Otherwise, I'm really excited that you guys showed up. I'm really grateful to people on the call. And I hope to see you next time, okay, guys, thank you so much. See you soon. Bye-bye.